So, GST, does that word just make you want to run for the hills? Look, you're not alone. For so many busy business owners here in New Zealand, it's a total headache. But what if I told you we could get you sorted in just the next few minutes? Stick with me because we're going to break it all down, make it simple, clear, and hopefully way less stressful.
Okay, so here's our game plan. We've got this broken down into 4 key parts. First up, we're going to hit the absolute basics. What even is GST? Then we'll jump into the day-to-day stuff. You know, the record, file, pay cycle. After that, we'll get into the slightly trickier bits, things like adjustments. And to wrap it all up, we'll cover common mistakes, how to fix them, and what happens when it's time to say goodbye to GST. Sound good? Let's dive in.
All right, first things first. Part 1. What on earth is GST? Really? Let's pull back the curtain on this thing.
Okay, so at its core, GST is just a 15% tax on most things sold in New Zealand. But here's the crucial mind shift you need to make. If you're GST registered, you're not really paying it, you're collecting it for the government. Yeah, seriously, think of your business as a temporary holding account, kind of like a piggy bank for the IRD. You just hold on to the cash before you pass it along.
So, does this apply to you? Well, the magic number to remember is $60,000. If your business turnover cracks 60 grand over any 12-month period, and that's a big one, it's a rolling 12 months, not just the financial year, then you must register. Now, if you're under that, you can still choose to register. It's voluntary, and sometimes there are good reasons to do it.
And this is where things start to get pretty cool, because GST is a two-way street. So yeah, you have to add 15% GST to everything you sell. But, and this is the good part, you also get to claim back the 15% GST that you paid on your business expenses. We're talking everything from your accounting software to the coffee you bought for a client meeting. It all adds up.
Okay, so we've got the what down. Now let's get into the how. Section 2 is all about that regular rhythm, your core GST responsibilities, the whole record, file, pay cycle.
Now, first up, a quick heads up on a pretty big change from 2023. You know the term tax invoice? Well, you can pretty much forget it. The new lingo is taxable supply information. What does that actually mean for you? Well, it's way more flexible. The info doesn't have to be on one single perfect document anymore. It could be spread across an email and a bank statement. But here's the one thing that has not changed. You've got to keep these records for 7 years. No kidding.
So that brings us to what I call the GST loop. It really is a simple 3-step dance. Step 1, record. You've got to track all your sales and all your purchases. Step 2, file. You'll submit your GST return online. Most people do this every 2 months, but you can also do it monthly or every 6 months. And step 3, pay or get paid. If you collected more GST than you paid out, you pay the difference to the IRD. But if you paid out more in GST than you collected, cha-ching, you get a refund. It really is that simple.
Okay, a key choice you have to make is your accounting basis. It sounds technical, but it's not. It just comes down to when you account for the GST. With the invoice basis, it's all about the date on the invoice. You send an invoice, you owe the GST, even if you haven't been paid yet. But with the payments basis, it's all about when the cash actually hits your bank account or leaves it. Much simpler.
So, which one is for you? Honestly, it all boils down to your cash flow. Just think about it. Say you send out a huge invoice. If you're on the invoice basis, you could be on the hook to pay the GST to IRD weeks before your client actually pays you. Ouch. That can be a massive squeeze on your cash flow, and that's exactly why most new and small businesses go for the payments basis. It just makes life easier.
Okay, let's move on to Section 3. Now this is where things can feel a little bit more complex, but I promise we'll make it simple. We're talking about GST adjustments. This is all about how you handle those assets that live a double life. You know, things used for both business and for yourself, like your car, your laptop, or your phone. So this idea is called apportionment, and a company car is the perfect example. Let's say you sit down and work out that you use the car for business about 75% of the time, and the other 25% is for personal stuff, weekend trips, groceries, whatever. Well, it's pretty simple. You can only claim back 75% of the GST on the car's purchase price and all its running costs. It's all about being fair and finding that split. And here's a really easy rule of thumb to remember. The more expensive the asset is, the longer you need to keep an eye on that business versus private split. So why's that? Well, because your usage might change over time, right? Maybe that work ute starts getting used for a lot more fishing trips. If that happens, the IRD expects you to adjust the amount of GST you originally claimed. And here are the specific rules straight from the IRD. You can see how it works. If you've got an asset that costs, say, between 10 and 20 grand, you've got 2 adjustment periods to track. But if you go big and buy a commercial property for over $500,000, yeah, that tracking period jumps all the way up to 10. It's just something to be aware of.
All right, we're on the home stretch now, our final section. Let's talk about the real world, mistakes, because let's face it, they happen. And we'll also cover what to do when your business's journey with GST is over.
You know, the IRD tends to see the same common slip-ups time and time again. Topping the list is exactly what we just talked about, not accounting for the private use of an asset. Others include just forgetting to include some sales, getting your timing wrong between periods, messing up registration or deregistration dates, and yep, good old-fashioned data entry errors. Honestly, just knowing what these common traps are is half the battle.
Okay, but what happens if you do spot a mistake after you've already filed? First thing, don't panic. Seriously, there's a super simple fix for small errors. If the mistake is under $1,000, you can usually just fix it in your next GST return. No need to refile or make a big deal out of it. It's designed to be easy.
So what happens when it's time to close up shop? Or maybe your turnover just drops back below that $60,000 line. You'll need to cancel your GST registration. You have to let the IRG know within 21 days. Then you'll file one final return. But there is one last crucial step that so many people forget. You have to account for the GST on any business assets you're planning on keeping for yourself. So if you're taking the company laptop home for good, you need to sort out the GST on it.
Look, if you take just one thing away from all of this, let it be this. Good record keeping is your business superpower. Seriously, this isn't just about following the rules or avoiding trouble with the IRD. It's about making sure you claim back every single dollar of GST that you are legally entitled to. That is cold, hard cash that goes right back into your pocket, into your business.
And just like that, you're well on your way. So I'll leave you with one final question to think about. After everything we've just covered, what is one thing, just one small thing, that you'll change in how you handle your GST? What's one tweak you can make today that could save you a ton of time, money, or stress in the future? Something to think about. Thanks so much for joining me.